All right, let's get to it. Some interesting things have happened since I think I've last met with you guys, because I think I had to cancel last week's meeting get together. So obviously we've had some notable events, binary events in a bear market. We've had the CPI, and then yesterday Mr. Powell did his thing. All right. So you had two, like I just mentioned, two pretty notable events. And, you know, did it change much of what we've been talking about week in, week out on these Zoom meetings, webinars? Honestly, I don't think so. And that's not, you know, that's not a good thing for us, because, I mean, let's think about things, right? Forget bullish, bearish, or in between. What we really want, and, you know, that's why I made a joke just now that, you know, the opposite. I don't need a break. I need some action. Our main goal is to survive this time, right? To get through it, to not beat ourselves up, lose all our money, so we can take advantage of the start of a new bull market and the turn whenever it may come. Okay, that's goal number one. If we can figure out a way to come out net positive during that process, that's a win-win, right? Regardless of how much of a profit it is. Okay, but the number one goal is to not get buried. Okay, and knowing that, when you know that your primary goal, that's where you really, you know, got to find the discipline. A lot of traders like to throw that word around loosely, discipline, in bull markets, where, you know, when things are going well and you got nothing but action around you, it can be a lot easier, right, to stop out and go to the next one, or sit in cash for an hour until a new opportunity presents itself. But this is the climate, especially bear markets, not corrections, but these lengthy bear markets where, you know, that can be obviously tested, and we're seeing that all around us. So our number one goal is to get through it. And what we want to see develop, as we're kind of sitting on the sidelines and being nimble and trading here, right, in the process, we want to get through this as quick as possible. Okay, we don't control that. We don't have a choice in it, but obviously that's where we're rooting, right? That's where we whip out the pom-poms, and we start cheering for that side to get through this as quick as we possibly can, so then we can do our thing again. Okay, and the only way really to get through this, right, and this is something we have spoken about ad nauseum all year, the only way to get through this in the quickest possible way is, I guess you could call it two ways. One is the Fed breaks something in the process. Okay, so by them aggressively draining liquidity, raising rates, and tightening financial conditions, something somewhere either breaks or freezes up, where they can't continue to do what they do, and more than likely have to start doing the opposite. Okay, that's the quickest way. And I guess this is more 1A than 1B, because they usually come together. But capitulation, all right, investor capitulation, is the other way. And that's another way, because what that will allow is the majority of selling is done. And even though things may be volatile still, right, and markets could be choppy, it doesn't have to be straight up from there. We could feel pretty good that the majority of the selling has been done, and the downside from there is limited compared to the upside, right? Risk reward. Again, this is nothing new. We've been talking about this all year, okay? Literally since the start of the year. But the reason I bring it up to start today is, you know, every time we go through these binary events, Fed meeting is the more popular one, or inflationary numbers like the CPI. That's what, I don't know if you are, but that's what we should be rooting for, right? Something an event to trigger the start of one of those two things happening. Okay. And we've, even though we are rooting hard, that hasn't been the case. Right. And we'll talk a little bit about both of those things today, because I think they're the most important things to pay attention to. Okay. So you had the CPI number, hotter than expected. Nobody, even the hawks out there, nobody was expecting a hotter number off that CPI, right? Even people who think inflation's around to stay thought we'd see a little reprieve there, but remained sticky, right? That's the new term, sticky. But, again, surprise to the upside of the CPI. So it caught some players off flat-footed, and you saw that immediately in the market. You had this little rally going in, people expecting a better CPI, right? And boom, gave it back all in one day, okay? And then you run into the Fed yesterday. And, I mentioned this in the write-up I wrote last night. I mean, I never thought there was any possible way that the Fed would end up hiking 75 and it be something attached to, something not expected in the market, right? Everybody and their mother was expecting 75 basis points, almost to the point where there was some chatter that they do a full one, right? A full 100, and 75 might be dovish, right? Compared to that, okay? So if anything, people were expecting 75 for the reaction to be dovish in a sense, if anything. But in the presser and the rhetoric around it was basically as hawkish. I think if he did 100, it would have been more dovish compared to what went on yesterday out of Powell's mouth, right? I mean, the messaging, he did everything possible to drill it into everybody's head. And simply put, not to even go over what was said, but just simply put, if you're interested in holding risk assets or equities, in particular, what we're talking about here, that's the last thing you wanted to hear was what came out of his mouth yesterday. The last thing. And that's why you're seeing rates get a nice kick in the ass, right? Since, right? Again, we've been watching this off what Hartnett's been talking about of recently, right? A breakout here. And you can see, yields ran into spots to where maybe we see a little breather here. And that would allow things on the equity side, even if it didn't mean upside as far as at the index level in equities, under the hood, there'd be some opportunities while this thing hung around, a resistance area here. But again, the Fed did what it did. Powell said what he said, and here we are. Okay, so the one bad thing, okay, as far as reaction that we didn't get off of Powell, we almost got complacency off of that uber hawkish rhetoric coming out of Powell. In other words, I'm trying to find the right way to put it. I don't think players were as concerned as you thought they should be off of that rhetoric, right? Here and there were definitely people concerned, especially on the professional side. But as a whole, example, put the call ratios, right? Nothing. We looked underneath the put the call ratio. There's been put selling on as far as SPX is concerned, right? Opening put selling, which is bullish. Okay, so we didn't see anything. Forget about capitulation. We didn't see anything even near some nerve or fear coming off of that. Okay, and going back to the intro and where I started, that's what we're looking for. That's what we're looking for, because the process right now, okay, the process for this to shake out step by step, level by level, okay, without capitulation or without the Fed breaking something, is a lengthy lengthy process, like literally a lengthy process. And I know we're into that process already, but you still have so much to do if you don't get something breaking or investor capitulation, right? We still haven't seen earnings really crack yet, right? There are steps that if we're going to take the long route and wait step by step for things, things to go on according to their own clocks, because, this is something else, again, we talk about a lot. What the Fed has done is barely in the economy yet. You understand? Like, we didn't even see it. We're all the negativity has stemmed from inflation and, supply issues and all that shit. What the Fed has done to combat those issues, we haven't seen the harm coming out of that yet. And trust me when I tell you, there's going to be an impact from that. You don't get 75 bip hikes like they're going out of style and the economy not see the impact. And, you see it, in other words, you're seeing it in housing, right? You're seeing it in some parts out there, but that's nothing. That's nothing, So at the end, whether the Fed breaks something or not, it's going to look, and right, again, this is not new, but it's going to look a lot uglier than it does now, a lot uglier. And another point, right? Like, there are still too many people out there looking for a bottom. There's still way too many people looking for a bottom. Way too many. All right, these bottoms, major bottoms like what we're going through right now, they show up when nobody even wants to see it. You understand? They don't even want to hear it. Like, if you met, I think the market bottomed. I think the market bottomed yesterday. They'll punch you in the jaw because they don't want to hear it. That's how disgruntled they are to equities. They're not searching every day on CNBC halftime. Did we bottom yet? Or did we bottom yet? Did we see the lows yet? Or the lows going to hold? You know what I mean? You don't see that. You don't see that. So, again, it's nothing new. We've been talking about it for a long, long time. And that's why there's no way to really put a time frame on it. Nobody can predict how long this is going to go. Nobody can predict it. Like I said, if the Fed, because of what the Fed has done, if something major happens, it doesn't even have to be in this country, right? It could be out of this country. Because of the Fed's actions, something can break. You understand? So how do you predict when that's going to happen? We look at a couple things here and there to see if there are any early signs that the market's pricing that in. And I got news for you. The market's not pricing in anything potentially breaking in this country. Credit spreads have been moving in sync with the market. They're not doing anything crazy, So, like, credit default swaps, they're just trading alongside what the market does on a day-to-day basis. They're not taking it, there's no leadership out of it. They're not, in other words, they're not controlling prices out there, credit default swaps. Nobody's showing any concern of major bankruptcies or anything like that yet. So more than likely, it's going to have to be outside of this country if something's going to bust or freeze in the near term, So, and, we talk about, again, capitulation. Now, granted, the professional side, the professional side of this market, as far as positioning is concerned, is in cash. Institutions are in cash. Hedge funds have been fairly hedged and neutral for a bit now. So the professional side is pretty much there. The investor side is not. Okay, what happened? You have a whole new, whole new influx of investors that have come in. They were giving money into off the COVID lows and stuff like that. At best, what has happened is those active traders on the retail side have now turned into investors. So what they've done, PLTR, which they bought 10 points higher for a trade, they're averaging down and turning it into a long-term hold, and now, something they're going to forget about for the rest of their lives. But they haven't sold, they haven't thrown in the towel. And, that's kind of what we need to see. Of course, private Twitter, search. Oh, here it is, perfect. Okay, it's kind of what we need to see before we can close the book here. Now, as you heard me say, we potentially might be starting to see some early cracks where we're starting to see some outflows instead of just steady inflows. And the reason for it, the primary reason for it, and this is a whole other can of worms, by the way, the primary reason for it is you can now not own equities and own bonds or park your money in cash and make some money. How about them apples? All right. So it shouldn't take long before all these guys who ran in last year chasing the highs say, what the hell am I doing? I'm watching my equity account bleed to death, and I can just leave it in a money market and make some money. You know what I mean? With no risk at all, right? So, I don't want to jinx it, but it's hard to be too much longer than what we've been seeing. All right, like this is a tough nut to crack. Okay, when you got this, okay, that goes on for such a long time, where they want nothing to do with equities for years. Okay, that's how turned off they are, to the equity market. And then they come in such a big way. Obviously, it's not going to just roll over because of some volatility in the equity markets. But, I think, again, it's an opinion. I don't know for sure, but I think we're getting closer, especially as the economy starts to deteriorate, people lose their jobs, and they have an alternative to put money in a money market and actually see a profit. So, that's what we're faced with, right? So that being said, again, this is nothing new. I just wanted to, again, touch base with you guys. Haven't spoken to you 2 weeks. There were 2 major events. And I wanted to catch everybody up to, where our thinking's at. In the meantime, I think there are going to be more trading opportunities, and most of you members know because we've been talking about this, in individual names. Okay. Now, again, like I stressed to members quite a few times, I sound like a broken record. That doesn't mean I think that if there's some action in Apple, you buy Apple and hold it for a whole new bull run. I think there's going to be more trading opportunities in individual names. I think that even though the overall market may be doing something different, there are going to be more names and subsectors that buck the trend temporarily. Okay, temporarily. So we go through a multi-week period or a month period where, the select high growth names that are seeing some action are holding up better and pushing higher while the market's been flat. That's what I'm getting at. Now you're probably saying, well, what's the difference to what we've been seeing? If you've been paying attention, from the beginning of the year all the way up until recently, we have, at least I haven't had that. I haven't had that. I've been primarily playing squeezes off the overall market by playing the overall market, not names, because my concern was that why, if I'm betting on a rally at the index level, why would I take the added risk and buy a name? You understand? Makes no sense. So now it's a little different of an outlook where I don't have to rely solely on what the market may be doing. If XYZ is seeing some action that I like, the market could be dead that particular day for me to have an interest for a trade. So that's the difference. That's the difference. Okay. And in the meantime, as we do what we need to do to try to get through this, what we want to keep our eyes open to is accumulation as far as flows are concerned, okay, at the sweeper level. So sweeper activity that is showing signs of accumulating names, not one day, you understand? Not one good looking sweep, but as this market doesn't do anything special, we want to see that consistent, steady accumulation in a particular name. And the longer we see that accumulation name, the stronger the signal will be. Okay? Because again, even names that are catching flow, they're just trades right now. And you either are going to, look at it that way, or you're going to learn the hard way by holding on to things that you think have bottomed and make new lows. Right? I'll give you an example. There have been, since we've been talking about this, which I don't know, I lose track of time, maybe a month now. We're in mid-September already. Jesus Christ. So it might be a little longer than a month. Since some individual names have been catching action. There have been names that have been bucking the trend. The market hasn't done much. The market has been net lower. There have been names, a handful of names that have seen sweeper activity and have actually went higher while the market went lower. Okay. My point is, doesn't mean those names don't turn around and make new lows next month. It wouldn't shock me one bit if some of those names make new lows. You know what I mean? It wouldn't shock me one bit. I don't think anything is safe from that. Anything. Like right now, they've been taking out their anger, sellers have, in anything economically sensitive and cyclical. Okay? I got news for you. I think the growth names aren't too far away before that selling and anger gets taken out on them again, especially with rates, pushing higher. So it's just what would, it's the market we're in. So that's why I'm stressing with, their trades. Those are the opportunities now. Okay. It may be worth playing in a name over the short term as opposed to just playing the market for the reasons I just gave before. Okay. That's the only thing different that we've been seeing, from the flow. Other than that, I don't see, like I told you guys week in, week out, and even if I wasn't convinced or not, I would share with you, but I don't see any sign whatsoever from the sweeper activity, out of sweeper activity, that they're, positioning for the start of a new bull market. And sweepers are usually early. They're usually early when it comes to that stuff like that. In other words, you'll see sweeps and into names, and the names are sitting there because the market's shitty, but they keep sweeping, and they're new names and likely new potential leaders of a bull run. There's nothing. There's nothing. I think we've seen literally one new name, one day of action in one new name that I can remember, and it's this guy here. SMCI. Okay, one new name on one day. It was just the other day. That's off the top of my head, that's the only one I can remember. The only one I can remember. There's been some action in, some of the bigger names, right? Some repeat action in some of the energy names, but nothing new that's signaling the start of a new bull phase, we should be starting to see a decent amount of that if we're getting anywhere close to that. Sharpies are still net long, completely net long. And here's Sharpies and Mifref. Okay. By the way, talking about sentiment, right? And we talk about like the pros being out of the market and the only ones left are really investors. If you ask me, honestly, like I think that's the only reason that the S&P 500 is anywhere near 3,900, 3,900 is because of positioning. I think that's the sole reason, is that the professional side, who follows it a lot more closer than the retail side, has been in cash for a lengthy period of time now. You know, and if you have one argument, probably the best argument for potentially these lows holding and some range bound market, right? That we're talking about, that would be it. That would be it. Otherwise, there's not one reason I could think of for that. Now, in other words, a good thing, a bullish nugget. Here, let me get the Sharpies here so you can see what they're doing. So for anybody who's new, Sharpies are commercial hedges. We refer to them as Sharpies, right? And what we usually see from them, not all the time, but usually they take the other side of speculators, all right? So in the futures market, you have, where's the weather chart? Oh, here it is. Okay, in the futures market, in index futures, you have speculators that look the opposite of this, right? So speculators recently off this low here, okay, literally into those lows, were aggressively short. Okay, they've covered a little bit and then put them back on into this major squeeze that we had here, okay, but they are still heavily short as of last week, heavily short. Okay, so these guys, which are some people refer to them as dealers, right? Think of that like the casino, right? You got the gambler and you got the dealers, right? These guys are the dealers, all right? So the house usually wins type of theory. These guys have taken the other side of it, as you can see, right? Into these lows. That's where they really got aggressive. And they've stayed significantly net long throughout, even as the market came down. Yeah, we get a new update tomorrow on this. So we'll see, you know, maybe they even added more. But honestly, guys, as far as like normally, especially in corrections, you see something like this, and this would be the signal of a new bull market. It would be, okay? But this is not your average correction here. You know what I mean? This is a whole new can of worms here, a whole new can of worms. This is not your normal flush them out, spit them out correction. This is a full-fledged bear market where the Fed is actually against you, right? Rigging the game the other way. Like, think about what went on yesterday. Can you imagine, like, the market has been as rocky as it has, and you would ever hear the Fed or Powell say something like he did yesterday? Right? Like, rewind to, the COVID lows or last year at any point. I mean, and obviously, the wild card's inflation. He basically has to, in a sense, even though a lot of people think he's too late, and something's going to break, right? That the track record shows that. But for us to just go off professional positioning being so dire and base, the start of a new bull market just off that, that's a lot to ask. because like even we talked about, Lulu, remember, like, even if these lows hold up, right? Even if these lows hold up, that really means nothing. It means nothing. Doesn't mean that it's the start of a new bull market. All it means is that maybe what everybody wants, right, the blow up, gets pushed into next year, which is certainly possible. Certainly possible, right? So in simple English, you get a test here of the lows, possibly maybe even breaches it a bit, and then you get something to this effect into the end of the year, and then next year you go and make new lows when positioning is not as washed out. Right? That's not far-fetched. That's not far-fetched at all with the way things are lined up on the positioning side right now. But things are, the backdrop is just, it's so disgusting. I don't know how, I don't know any other wording to use. It's so disgusting. Okay. I'm being honest with you. Throughout my career, if you told me to grab a pen and make a list of things as far as in the background of reasons when not to own equities, okay, I mean, every single one of them has been checked off in this phase we're going through. Every single one. Like one cardinal rule, okay, the number one commandment is never ever own risk assets when the Fed is tightening into a slowdown. That's no number one. Don't even think about it. Don't even think about it. You understand? Do not even think about it. That is the single worst thing you could possibly do. Right? The most important thing to avoid. And, what do we have now? We have not only the Fed, central banks around the globe aggressively tightening, raising rates, implementing quantitative tightening into literally a global slowdown. It's just, it's bad. It's bad. And the reason why it's bad is there's so much bad ahead. I keep making the point. What they're doing now, you are not seeing the consequences, the impact of what they've done here now. You're not seeing it. You know what I mean? Right. And there's another 125. That's why a lot of people kind of, were a little rattled off that. Like he's got, will he do it is a whole nother story, but there was not one word in there showing legitimate concern about, the housing market falling off a cliff and setting off a fire. Like he almost welcomed it, right? You heard him say the housing market was like, yeah, we need a nice reset. That's basically what he said. We need a good reset in the housing market. And guys, I don't disagree with any of it. I'm being dead straight with you. What we've seen happen, where money started to go into this last run up, okay, it was awful, and that needs to be cleaned out. It needs to be cleaned out. You need, to get a healthy bull market where we can strive and make money and pick growth names and have fundamentals behind us, the whole 9 yards, okay? You need the wall of worry. You need this, okay? You need this. Where the average investor out there spits on every rally that shows up because they don't believe. That's what you need, okay? Because you buy every dip, every credit card. I'm reading your thing, every credit card. Every correction is an opportunity. You know what I mean? Every correction is an opportunity when this is going on. When this happens, now you have major risk. So what the Fed is going to do is they're going to help us get this back down there and stay there. That's what they're going to do. And like we said, it takes time. It takes time because even if the Fed stopped here, right? Even if the Fed listened to people that say they're overdoing it, okay? If they stopped here, what happens? What's this going to go like this? Who the F is going to want to get long and hold positions into that? You know what I mean? Who the hell's going to want it? You talk about risk. What the hell are you going to want to do with this? Right? If the Fed stopped right now doing what they're doing the Fed pivot came back into play, the Fed put with this up here, you got disaster. You don't think all that stuff? Here we go. Every Zoom video, we talk about it once, notch it up. You don't think NFTs and jarred farts and all that shit's going to heat up again? How long do you think it take before all that shit heats up? Come on. If the Fed stopped tomorrow, if they pivoted, you'd have every jabroni out there jarring their farts. And you know it. Yeah, tomorrow. I'm saying if the Fed stops now. So, now. Yep. Exactly. So, I don't want to sugarcoat things, but this is good. But the problem is trying to get through this. You understand? And I see it already. Stage by stage is happening. You're seeing a lot of, especially the newer traders, investors getting frustrated. You see them going away. You see them little by little going away. Okay, that's all part of the process. They're going to go away. I don't know if they capitulated completely yet. What's going to happen is people lose. You're going to see a lot of players lose interest. They're going to lose interest. Okay, especially the latecomers, the guys who never had a passion about the market. They just thought it was easy money. I remember in 2000 when the bubble burst, I had all the kids I grew up in Brooklyn back in the day. They started to get into equities in 2000 and 99. You know what I mean? Like you talk about a sign of a top. That was the telltale sign. The top was coming. When all the Brooklyn boys all of a sudden started trading equities. And, where'd they go? They started to lose interest little by little, right? They went to mortgages. Then that blew up. Everywhere they went, it blew up. They started to, honestly, it was like I remember too, right before like 9/11 is when I started to see like they were giving up on it. But, they were buying dips all the way down. And you still that's what I fear. You still on CNBC, you have people almost guaranteeing people, watchers of CNBC, to keep buying on the way down if you have some time on your side. They don't realize, they don't know what markets can do. You know what I mean? The NASDAQ, you bought those names on the way down. You never held them. You know what I mean? They didn't even come back to begin with, but you didn't hold them till they came back. Yeah, the NASDAQ itself, exactly. Good call, Saeed. The NASDAQ took a decade before the index came back. And you know what it is, Saeed, too? It came back, you know why? Nobody talks about this. They changed the names that made up the index. If they left the same names in, it would have never came back. It would have never came back. Some of those names went bust. You know what I mean? Some of those names went bust. So, these are all things. Again, you can't put a timetable on it. You can't put a timetable. The best we can do right now. The best we can do. Okay. And now we have, I think, more to be entertained and play with at the same time. More opportunity in individual names. but we still want to be smart about it. You know what I mean? We still want to be prudent, because the number one goal, as corny as it sounds, is to just try to survive this. Survive it. If you can, like I said, if you can squeak out some green in the process, yeah, and I'm telling you, it's worth it. It's worth it if you do survive it, because that's where everybody gets made. Any real player, I'm talking about real player, okay, that has made it in this game, they all had something like this to jump off of. All the players that come in 99 or when things are red hot, those are the ones that vanish because they're done. They blow themselves up, right? It's the players that hang around and are still around with bullets to fire when the dust settles. That's where the money's made, man. That's where the money's made. You know, that's where the money's made. Do you think there will be something for traders to trade every day? I put it this way, like, you see, that's a hard question to answer, especially to say yes to, because when you have like what we've had recently, right? You had the Fed, and it was even more hawkish than people expected, right? So you had rates go higher. You know, this is not necessarily a day where you want to play the long side, right? So yeah, if you're playing the short side on an intraday basis and stuff like that, you know, you'll have something to get involved in. But if you're just focusing on the long side, you know, you gotta wait around for select opportunities. And those opportunities, you can't look at them as, you know, diamonds in the rough. You know, you look at them as a possible place to make a little bit of money in the interim. You know, that's the way you got to look at it. Maybe you get lucky and something goes your way, you know, and you make a little more money than expected. But you just try to make some money and then sit tight when things go sour. You know, they've been, you know, again, since this, right, this was a nice rip here. This was a nice, healthy rip, right? With some decent names moving in it into the CPI, okay? So you had a binary event. You don't want to hold anything through that. And then when the CPI came in hotter than expected, momentum flipped. You know what I mean? And then you had the Fed yesterday pushing it a little further. So now there's going to be at some point, there's going to be a little turn, and we want to make some money in it during that turn on the long side. Yeah. And McBob's right. You know, that's, I guess, the point I'm trying to make. There are going to be certain sectors and certain names, right, that don't look identical to the index, you know, and that's what you want to focus on. And if you on a short-term basis, it doesn't even necessarily have to be that defensive. I mean, look, I'll give you an example, right? Names, all the names we were talking about that were catching, you know, some long-term flow and short-term flow, and some just speculative short-term flow. But you could see they were catching flow, right? We mentioned like these names we were talking about, right? Like a Pinterest, okay? Or a DraftKings, right? Like this thing, I wouldn't be shocked this DraftKings ends up at new lows. It wouldn't shock me one bit. It's not like we're seeing huge accumulation with time in this name, but you know, it had a few days of, you know, weekly and front month activity where there was some momentum in the name. That's all I'm saying, right? And you look at like the pins, okay? Right? You have the S&P 500 looks like this, and pins has looked like this, right? So while there was action in the name, you got some positive momentum, you know. So that's what I'm getting at. But right now, for me, anyway, okay, and it's based off the flow I'm seeing, nothing else. I don't see anything convincing enough to start accumulating positions in. I'm being dead straight with you. And you guys know I like to do that. I don't see it. And not only just the order flow, the amount of sweeps or anything like that, There are no new names, okay? Even if they're defensive sectors, there should be new names. That's the best sign of the health of the market. You understand? Even if the indexes chop around, we should see new names, seeing accumulation, and those are the names that are going to look a little different than the indexes. We're just, it's not there. It's not there. You know, it's not there. Like, all right, today there's action out there. There's selective buying, but you know, you gotta be honest with yourself and say, all right, you know, you have a market that's selling off with the Fed. Okay, you got one name that's seeing some decent buying. Every other name seeing put sweeper activity. Like, you know, do you really want to sit long in that name right now? Is that the type of backdrop you want to sit in the long? It's just not. You know, on that note, let's go over some of the names quickly. I won't keep you guys long. While I get that, I'll go to this because I know you guys are this. Hold up. Oh yeah, and I'll pull up the top. So this is where we're at. We're back close to where we were, where we last bottomed. Okay, again, this is here. This is what we're waiting on, right here. Global equity flow, just equity flow in general, and that's what's holding us back. Yeah, here you saw the chart. It's sideways, bull flag or bear flag, whatever you want to call it. Where's the top bet list I have here? Oh, here it is. Hold on. Okay. So here's some of the action from today. Again, I'm warning you, not a lot, and there was some put sweeper activity out there. But these are some of the names you could keep an eye on if they see some additional activity and the market is hanging in there. You might find momentum in these names. So let me do this. I'll put it in the room too when I'm done here. Okay. All right. So here we go. Let me take this off. All right. So here are the Goldman sentiment indicators you guys asked for. Again, the majority of stuff is there already. It's just the flows, fund flows. That's not. Where am I? Oh, here we go. All right. So like this is this would be in the category of a newish name. This was actually a repeat bet. Caught some action in the past. A couple, maybe what was it? A couple weeks ago? Could be a month ago. Again, I can't keep track of time anymore. But it's energy related. All right. So there's been some decent buying in energy, you know, since the start of the year, going back to last year. All right, this had an update. I think it had some news, so into strength today. All right, but this is a newer energy play. I don't know too much about it, but saw some more action again. October 30s. Okay, this is not a name that catches a lot of action. Okay, but a couple of weeks back and today, some decent sweeper activity for a name like this. All right, that was into strength today. Google, one of the few high beta names, FANG names or big guys, that caught some call buying today. What the hell is that? The rest of it was put sweeper activity. Like Apple could have been just protection, but Apple saw some put sweeper activity today. Okay. Tesla had some put sweeper activity, mostly in the morning. Okay. Google had some buying. All right. We also had seen, was it yesterday, the day before, Google, there was some buying leaps. So further with time. Okay. So something to keep an eye on. All right. Something to keep an eye on. Now we get that turn, right? We get some sort of squeeze. Maybe Google's the one you want to go to. All right. Especially if it catches more action. All right. So something to keep an eye on there. AMD caught one sweep, nice size, but it was just one sweep. This thing got hit too, right? Today, I think it got hit. Let me see. Oh, AMD. Look at that. So again, if we get a turn, you might, you want to look for a pickup in action there. Honestly, off one bet, I wouldn't buy it. I'm telling you the God's honest truth. I would, this is average size for a decent AMD sweep. You know what I mean? But for a bounce, without a doubt, right? Market turns, momentum shifts for even for just a day, for a day. PayPal saw some longer term buying. We know we got Elliott there. That stock got hit today. Again, not a lot of it, but into the weakness, you saw some dated call buying show up again. Okay, so again, a name just to keep an eye on. And BP, that's an energy name. We've seen a lot of flow in this thing going back to last year, and saw some April activity today. So it's kind of been just choppy here, right? Half a day, exactly. So, for here's what you want. Like, if we want, let me see the word this correctly, right? Half of this type of rally, okay? Even just half of this, okay? I'm talking about a multi-day squeeze, okay? What we would want to happen to time it pretty decently, you want to see a pop in VIX, and you want to see the put to call ratios pop, okay, to time it properly. All right, otherwise it could just sneak up on you at any time, right? Because sentiment is there. It's there for a squeeze, without a doubt, right? So let's say I give you an example. Tomorrow, okay, we come in and we see some more selling in the market, and you see these things pop, right? And VIX have a decent pop, right? VIX has done nothing. That's not, I don't take that as a good sign. I'm not even a VIX guy, but that's not what I want to see off that Powell rhetoric, Then you want to see a nice pop. You want to see a nice pop in it. And that could be a cue that a tactical low is in. You know what I mean? Because you're getting that short-term panic. Forget about major capitulation. We got a long way to go. We got a long way to go. Like the put the calls could get up there. Here you guys can see with the naked eye, and this is the trading view version of the put the call volume ratios, right? But you see the outliers. You know what I mean? Like you see panic. So that's kind of what you want to see for a panic bottom. It's possible. Yeah, this is tough. And I honestly, Eric, I really do think the reason why we're seeing this, think about it though, Eric, usually you get the pros to feed into that panic as well. You know what I mean? Yeah, right. Like, especially like 2-year yields to stop going higher every day, McBob. That would help. No? Literally every day these things are up. You don't want to see that. By the way, there was a nice put sweep in GameStop. You guys saw that, right? I called it the riffraff dagger. Let's see. I think some people on Twitter weren't happy about that. So here's we'll probably get an update today. Here's where hedge funds are at as a whole. Okay. So look, they from this point here, right, where they had decent long exposure, literally into the highs, right? Although they were pretty here at that point too. They've been de-risking, as they say, this whole bear market, So I think that's feeding, I think that's the reason why we're not seeing this, kind of capitulative behavior. Yeah. So, they like if they were long, like let's say you see this squeeze here, the bear market rally. If they got long into that, like I think we'd be seeing a higher VIX and even higher put to call ratio here. I think honestly probably would have long happened by now. But now it's like we're waiting for them we want to see a little push where they get short, right? So kind of like where they dipped into short territory right there, so they could get squeezed. We'll see. Might not be that long before they do that. Could be any minute now. Oh, McBob, there's so much that is in front of us, bad in front of us, that I can't even, like if I start to think about that stuff, I'm going to crawl up into a little hole. You know what I mean? That's why it's almost like you need the Fed to break something, McBob. You need them. You need something to freeze up or break. You need it. If we go step by step, this is going to be treacherous, no? If we go according to the dot plots or the Fed plan, McBob, I mean, you're telling me that this is going to go on like this into second half of next year? I mean, come on. Like, can that even be, McBob, you think that's even possible, though? You think the dollar could continue to do this into, like, late next year? Is that even possible? How could that be possible? Without something going bust? I mean, this is nuts. Yeah, he called the dot plot useless at one point. Now the dot plot's back in play. I think, starting the beginning of next year, you're going to start to see the rate hikes have a significant impact on things that they've done already. Forget about what they decide to do. I think it could get really, really ugly if they find a way to survive the rest of the year. Honestly, like it could be scary ugly. That's always the tough call. You know what I mean? That's always the tough call of, as far as like investments, longer term stuff, do you just keep selling it's always a tough call when you get into these type of markets, The easy answer is the stuff that's not trades that you bought with intention to put away and hold for almost forever. You got to try to leave it alone. What you want to do is save your bullets to buy when the time is right. You understand? Focus on that instead of thinking what to sell additional here, because nobody knows how much further downside it means. Like again, if what we said, if this goes on, if this continues, if the Fed gets their way and this continues into next year, you know what I mean? Then you could make an argument for S&P 500 sub 3,000 easily. But like you guys are saying, what? Yeah, you can make an argument for 2,000. You're right. But who's to say something doesn't break in the interim before that? Right? That's the problem. That's the problem. Eric, what's the point of that? Oh, what they want, the Fed feels that they want this to continue, right? So what they can do is when things get dicey, they think they can control it, take their foot off the brake, you get a little relief rally, and you just get a nice steady downtrend, and they don't care if the S&P 500 is at 2,900 at that point. It's kind of their job. They want that to happen. They want that to happen. They don't want to break something. This is exactly what they want, because you're going to kill inflation. You're going to kill speculation. You're going to kill Bitcoin. You're going to kill NFTs. All that shit will be gone. That's what they want. Yeah, well, the thing is, Eric, you got to understand something, okay? We can't have it both ways. And I'm not singling you out. I'm talking about all of us, okay? When shit hit the fan in COVID, okay, off of COVID, and we thought the end of the world was coming, and they threw in the kitchen sink. They created all of this, Eric. They made all this. You understand? They put all that money out there that went into jarred farts, NFTs, and all that speculation. So now they're just taking it away. Exactly. Powell giveth, Powell taketh. Yeah, without a doubt, Tanner. This is not even close. This is the most aggressive tightening cycle since Volcker. And, I obviously wasn't in the market at that point. I'm not that old, so stop it. I'm trying to say, this is as aggressive. I told you guys, I'm what I meant when I'm wrong. I honestly did not think they would do this. Even with inflation, I didn't think they would do what they're doing right now. I didn't see it. I didn't see it as possible. I thought what they would do is deal with inflation and take baby steps to try to tame it. I did not think that they would be this aggressive and damn the economy, damn risk assets, damn everything. But I guess they pushed Powell to the brink, calling them out. I didn't think, if you told me last year that this was going to happen, I would have not only been in my bunker with my 9 dogs, you wouldn't even known I was alive if you told me this was coming this year. I'm being dead straight with you. And if you told me that the S&P 500 would be at 4,000, I would have laughed in your face. I would have laughed right in your face if you would have told me the S&P 500 still be at 4,000. Honestly, I'm telling you that. So I'm wrong, obviously. I would have been wrong, but I'm telling you the honest to God truth. If you told me that they were going to do what they're doing this year when we were here, I would have said crash is the least of our worries. Eric, it would have been a lot uglier, I'm saying, than what we're seeing right now. Because who would want to own risk assets? Like, who would want, you understand? Like, if you can park your money in money markets risk-free while the Fed is hiking aggressively and implementing QT, why the would you buy stocks? You know what I mean? Why? Why would you want to go against the most aggressive tightening cycle in central bank history and risk your money with stocks when you can park it in a money market and see 4% on your money? Yeah, McBob, oh man, I spilled the coffee, a big one, but I didn't get the keyboards. Oh my God. That's what this market's going to look like. What I just did by January. Wow. Did you guys hear the splash? That might be a classic of Jesus spills on a webinar. That might be a classic right there. My dog, she shit her bloomers. She thought something exploded. Yeah, I'll get that in a little bit. That's a debacle. I got a swimming pool of coffee here. Oh my God. I'll deal with that later. I can't even think about it. No more snoring. So yeah, no, I haven't got the waterproof keyboard yet. I don't know what I'm waiting for. I went through about 50, at least 50 keyboards, I would say 50. Since you know me, McBob, how long is that? That's a long time now we know each other. I've been tattooing keyboards. You know me a long time now. McBob is getting me all excited. He's getting me all excited. All right. So let's clear the smoke here. Okay. Forget the doom and gloom for now. We know what we're up against. Okay. What we're looking for here now is a tactical squeeze. Okay. Tactical squeeze. If it turns into something bigger than that, we're going to see it develop. out of the sweeper activity. You're going to see them get really aggressive. Even if it's in weeklies, you're going to see them get really aggressive. All right. But what we are looking for is for a tactical squeeze to develop out of here. So based off at like the sentiment stuff we look for, we're looking at timing wise, I told you, we get a pop in the put to call and a little quick pop in the VIX. That could be their cue to start covering shorts. Because honestly, that's got to be the catalyst, the short covering. Otherwise, I don't see buyers getting too aggressive here. I'm not going to lie to you. It's got to be short covering that starts it off. Like, look, let me show you this, okay? Just so you know what I'm talking about. Like CTAs, they just started shorting again, okay? The last few days. All right, you can see here, this is the TD model, right? So here, oh, this was, look, so they were 8%, right? 8% a couple days ago. Now, I think I put an S there, that's why. Yep. Now, they're up to 12, 13%. See that? So they're starting to add some shorts. They've been starting to add some shorts into the weakness. Yeah, so that's good. That's good because again, that'll get them to cover and add some fuel to the fire. If we see the momentum turn here. All right, that's good. So same thing with like hedge funds, right? You see them kind of like just sitting there at the zero line. And we get updates from Goldman and JP Morgan, if we hear that they got aggressive one day, just one day, if they got aggressive on the short side, again, that would be a sign that a squeeze is coming sooner than later and could add fuel to the fire. Oh yeah, I heard Japan. I know. I mean, I really think the first thing that blows, I think, is going to be overseas. It's got to be, right? It's got to be. I don't think, and this is why I don't think it's here too, because of this. Okay. They've been moving with the market more or less. You know what I mean? Like a tell would be these things break out. And they didn't today. They were quiet today. So it's getting close. All it takes is one real push higher for that to start taking power. But you can see, this is almost a mirror image of the price action, like we've been saying in the S&P 500. It's been moving together. Yeah. Let me look at the charts. I didn't see them today on those. Another thing is this, okay? And this more so than the swaps. Look at this. Oh, no, I didn't word it that. That's why. Hold on. When was this? I got to post an updated one. But this hasn't done much either. This is the corporate bond spreads. So they've been kind of quiet somewhere around here. Usually if they're getting worried, you'll see these things stretch out. So, I heard in Europe, it's been a little different. They've been widening in Europe and stuff like that. So that's why I think, and you guys know about Japan with the currency and all that shit. I think it's going to be something in overseas first, overseas. We might get a double bottom little rally at some point here. No, I could definitely see that. Anybody have any questions before I go and pick up my coffee all over the damn floor? Before it embeds itself in there? Yeah, and that's the thing. Sahil, that's kind of what we're looking for here. Is there a decent multi-day squeeze that we get from here? You know what I mean? That's kind of what we're keeping an eye out for. And then we can make some, those could be nicely, profitable without a doubt. Let's see what you guys are talking about there. Oh, these things are already testing lows, huh? HYG, they're all there. Oh, LQD broke already. Nah, shit's this. This everything I look at so effing ugly. You know what I mean? Everything I look at so ugly. I never see anything that looks constructive or promising. Nothing. Everything I look at looks disgusting. Yeah. Wow. I mean, that's crazy that. Jesus Christ. Eric, there was so much liquidity pumped into the system, Eric, off the COVID lows. That's why this is taking so long, That's why. So much liquidity. I mean, think about it. We talked about it so long. Not one bankruptcy that we hear out of COVID. Think about that for a second. Not one bankruptcy did we hear from COVID, the whole world lockdown. They just flushed the whole system with more liquidity than you can ever imagine. Yeah, just a little guy, of course. You guys see the Fed balance sheet chart. I mean, that's, there was a ton of liquidity. And now it's starting to come out, and that's not good, man. That's not good for stocks. It's not good. But listen, when things get ugly, guys, watch how quick things start to happen. The fund flows, nobody interested in bottoms. Watch how quick when people start to lose jobs and the economy really starts to look ugly. I know, McBob, I know, but I'm saying it could unravel quick. That's what I'm making that point, that it looks far-fetched from where we are now. I agree with you. Diamond hands, man. Diamond hands. We should, right there, you knew it wasn't going to be anything but an ugly ending. Like diamond hands, you guys don't understand how superstitious I am in this game. Like, I'm crazy superstitious in this game. If anybody used a term like diamond hands around me, and I'm playing this market, I'd kick the living piss out of you. Diamond hands? That's like spitting in the market god's eyeball, right? Like, who do you think you are, diamond hands? The market can't shake you out? Well, you'll see, right? Yep. They need God himself, because the market gods, they're a fickle bunch. They make you think you get away with it, make you think you make a little bit of money and you beat them. They get it all back and then some. Exactly, HC. That's exactly what they're doing. Yep, body bags all over the place, I eat. All right, guys, let me pick up this coffee. Otherwise, I chit-chat some longer, but I got a debacle on my hands here. All right, good luck the rest of the week, and let's see, maybe we could catch a little turn here, make a little bit of money while we're sitting watching this disaster take place. Great, have a great night, everybody. Good seeing you guys again. Good talking to you guys. I'll see you soon.